think we'll make a start. Welcome everyone. This is the November Tax Support for Professionals webinar. Next slide, please, Jordan. So what have we got today? Oops, thanks very much. What have we got? We've got our usual quick fire items, all the exciting things that have happened in the last month, with Nigel Giles presenting on direct tax and Rob Edwards on VAT. We'll then follow that up with HMRC's latest proposals as regards charities compliance and how they think tax relief on charities should work. Helen Berry, who's a tax director in our charities and not-for-profit team, will take you through that. That's followed by Chris Holmes on how to interpret tax treaties and how to make the best of them. So all of those, I'm sure, will be very interesting sessions, and we've also got our final Q&A at the end. But if you've got queries for any of the speakers, then each session has a Q&A at the end. Do pop any questions into the Q&A box on your browser, and we'll pick those up at the end of each session. Anything that's left over, we'll pick up at the end. Could I have the next slide, please, Jordan? And here are your speakers and their contact details. What a handsome lot they are indeed. And next slide, please, Jordan. And I think we'll make a start. Over to you, Nigel.
Thank you, Malcolm. Go to the next slide, please, Jordan. Right, I'm going to start off by running through a few recent tax cases, starting with the Commission of Revenue versus Gerald and Sarah Lee. Fact pattern in this case, very simple. Mr. and Mrs. Lee bought a house and a plot of land in October 2010 for approximately £1.7 million. Between October 2010 and March 2013, development works took place on the land. The old house was knocked down and a new house was built for the lease elsewhere on the plot. In March 2013, the new house was completed and Mr. and Mrs. Lee moved into it. 14 months later, in May 2014, Mr. and Mrs. Lee sold the house and land for £6 million. And the question concerned how much private residence relief was due. HMRC's position was that the Lees had owned the land on which the property sat since October 2010, but not occupied it as a residence until March 2013. Accordingly, using the method of calculation required by the legislation, PPR relief would apply to only a fraction of the gain. Council for taxpayers, on the other hand, argued that the assets which the relief applies is not the underlying land, but it's the dwelling house itself. Since the dwelling house only came into existence in March 2013, was promptly occupied as the PPR, 100% PPR relief would apply against the gain. The upper tribunal concluded that the key paragraph in the legislation is section 223 subpara 2 of the Capital Gains Tax Act 1992, which works out the fraction on which PPR relief is calculated. Legislation refers to the period of ownership, but is unhelpfully unclear on the identification of the assets to which the period of ownership refers. The tribunal took the view that the legislation was silent because the draftsman felt its meaning was obvious. They concluded the draftsman could only be referring in this context to the dwelling house because that's the only asset referred to anywhere in the immediate surrounding legislation. In a detailed judgment, the upper tribunal then went on to review and dismiss each of the counter-arguments raised by HMRC. As this is an upper tribunal judgment, it sets a binding precedent on HMRC unless they can successfully appeal its conclusions to a higher court, and it remains to be seen whether HMRC will seek to do so. The next case is the case of Wayne and Beverly Bottomer, which is a first-tier tribunal case, which illustrates the narrowness of scope for claiming deductions against capital gains tax in comparison to other claims. Wayne Bottomer and his wife bought, renovated and sold a property. Development opportunity was introduced to them by a distant relation, Stuart Bottomer, who also helped to oversee the renovation process after Wayne fell ill. There was a vague understanding between them that Stuart would receive a share of the profits on sale. There was no written agreement. At the conclusion of the development, Wayne paid Stuart a total of £32,000, which represented around 50% of the profits on sale. HMRC refused to allow a deduction against Wayne's gain for the £32,000 paid to Stuart. Claiming an allowable deduction for CGT purposes is necessary for the expenditure to fall within the scope of a single section of the 1992 Capital Gains Tax Act, and that's section 38. Broadly, relief is allowed for expenditures incurred wholly and exclusively to acquire the asset, or for any expenditures incurred on the asset to enhance its value, which is reflected in the state and nature of the asset on disposal, or is incurred in establishing, preserving, or defending title to the asset. The tribunal concluded the services provided by Stewart, which included the finder's fee element, were not specific to either the acquisition or the disposal and did not fall within the other criteria. Relief could only therefore be available if the costs incurred could be defined as incidental costs of either the acquisition or disposal. Section 38(2) defines incidental costs as fees, commissions, or remunerations paid for professional services of either 1, a surveyor or valuer, 2, an auctioneer, 3, an accountant, 4, an agent, or 5, a legal advisor. Although Stewart was an accountant by trade, he was not charging for accountancy services. And similarly, although he'd acted as an introducer in sourcing the property, he was not acting as an agent in doing so. The tribunal concluded on their understanding of the factual background that no relief was due in respect to the fee paid to Stewart. The next case is the third case I'd like to mention is the first tier tribunal case, which deals with IHT business relief. This case is a good example of how difficult it is for any business which derives much of its value from the land on which it sits, to qualify for IHT business relief. I should stress, however, that each case turns on its own facts, and this was no exception. The case concerned a wedding events business operated through an LLP, which was all intents and purposes wholly owned by the late Mrs. Butler. The wedding events business centred around a barn on land owned by the LLP, which had been extensively fitted out to hold the wedding service and reception in an attractive rural location. The LLP offered various supporting services to ensure that the weddings proceeded as smoothly as possible. When Mrs. Butler died in 2015, the LLP and its assets fell within the chargeable IHT estate. The executors sought to claim 100% business relief against IHT. There's no argument there that the LLP was operating a business. The issue the tribunal had to consider was whether the business was excluded from relief because of Section 105, Subclause 3 of the IHT Act 1984, which denies business relief where the business consists wholly or mainly of excluded activities. Excluded activities, in this case, would be making or holding investments. The tribunal agreed with HMRC that the wedding business was primarily a business that derived its value from investment-type activities. The tribunal went to some lengths to make a close examination of the activities of the wedding venue business, and there's a useful section in the ruling where the tribunal considers each activity in turn and gives a view on whether it's investment, non-investment, or does not fall clearly into either category. The final conclusion was greatly influenced by what the tribunal felt the customers of the wedding event business were paying for. In this respect, they took the view the attractiveness of the venue and its suitability for the requirements of the marrying couples were the dominant factors. It was unhelpful in this case that many of the services of the wedding event business, such as the catering, were outsourced to third parties and weren't provided by the LLP. Go to the next slide, please. The last case I'm going to comment on is the conclusion of a long-running case, HMRC versus Vermilion Holdings, which reached the Supreme Court for a final ruling in October. The case has a complex fact pattern, but essentially turned on one single question. Mr. Noble exercised options that were issued for his benefit at a time when he was the chairman of Vermilion. The options in question had been issued as replacements for options that had been issued previously to his personal company at a time when he had no employment relationship with the company and had no expectation of an employment relationship with Vermilion. The question was whether or not the replacement options fell within the scope of the employment-related securities rules. If they fell within the scope of these rules, the option gain would be subject to income tax rather than capital gains tax. The taxpayer's argument was that the sole reason that the replacement options were issued was in order to replace the existing options, which would be diluted by a fundraising exercise. As such, they had not been issued by reason of his employment. HMRC's argument was this was irrelevant because of the operation of the deeming rule at Section 471 Subclause 3 via TEPA 2003. What Section 4713 says is that where a right or opportunity is made available by a person's employer, the right or opportunity is deemed to be made available by reason of employment, regardless of the actual causation. The only exception to this rule is where the right or opportunity is made available in the normal course of domestic, family, or personal relationships. This was not a relevant factor in this case. The Supreme Court overturned the previous ruling of the quarter session to determine that HMRC were correct. They concluded that Section 4713 had been deliberately included in the legislation to provide a bright line rule. So if the recipient was an employee when the options were issued, Section 4713 overrode all other considerations. Mr. Noble was an employee at the time that the replacement options were issued to him, so the effect of Section 4713 was to treat the options as employment-related securities, regardless of the actual reason for the options being issued. Last couple of things I'm going to quickly cover on the news items. This item is just a heads up an event that's in the offing in relation to Companies House operations. The Economic Crime and Corporate Transparency Act 2023 received royal assent on the 26th of October. Under the new legislation, it is intended that Companies House will take a more prominent role in improving the transparency of UK companies and other legal entities, for example, limited partnerships. Expected changes will include identity verification for company directors, persons with significant control, and persons making filings or delivering documents to Companies House. Restrictions on who can make Companies House filings. New powers to the registrar to check, remove and reject new submissions and revisit entries that are already on the register. Requirements for companies to provide appropriate registered office addresses, and additional requirements for accounts to be filed for small and or micro companies. In essence, the option for filing a breached accounts will no longer be available. And in future, each set of accounts filed by Companies House will be expected to include a profit and loss account and a director's report. Excuse me. In terms of timescales, when these changes come into effect, Companies House are suggesting probably early 2024. Obviously, as we learn more and new announcements are made, we'll be doing our best to keep clients informed, clients and contacts informed through our usual channels. Finally, just like to comment very briefly on the latest of HMRC Spotlight series. The Spotlight series has been around since 2010 and is used by HMRC to highlight tax avoidance schemes that it's aware of. HMRC is putting schemes in the spotlight as advance notice that it believes the planning doesn't work, and to highlight to would-be participants they can expect robust challenge from HMRC if they seek to implement the planning. This latest Spotlight 63, has identified a widely promoted scheme involving hybrid arrangements that is aimed at property landlords with significant loan balances. The promoted scheme involves the landlord and possibly other family members setting up both an LLP and a limited company, which will be a corporate member of the LLP. The idea is that the property is transferred into the LLP, and the partnership profit sharing mechanism is used to allocate profits between its members and the corporate partner in the most efficient way. One of the features of the scheme is it's set up to ensure that loan interest deductions fall to be allocated against the profits of the corporate member. There isn't really time to go through the full ins and outs, but if you wish to do so, there's a recent article in Taxation which reviews and largely dismisses many of the claims made by the promoters. We do get the occasional call on tax line from agents who are worried about clients being sucked into this kind of scheme planning, and I think the message to relay to them is that HMRC are watching. And I think that concludes the direct tax news.
Okay, next slide. So good morning, everybody. So just two things on the VAT side. One is an issue we're seeing with various clients at the moment to do with VAT grouping. Another one's the quite important case of the target group that was in the Supreme Court recently. So just on VAT grouping, this is in particular to where you're forming a new VAT group with already VAT registered entities. So you may remember November 21, HMRC issued some guidance on the back of the fact that there's such significant delays in approving VAT groups. Basically saying just continue to file your VAT returns. And then in March 22, they changed it and said, actually, no, what you should do is treat the VAT group as provisionally accepted and account for VAT on that basis, i.e. you don't submit the VAT returns for the single entities that are already VAT registered. Now, obviously, HMRC acknowledged the fact that this could mean that you get central assessments, that's the estimated tax due when the VAT returns aren't submitted, or you can get payment demands for those central assessments. Under the new late penalty regime, you can get penalty points, and you can also get the penalties for late payment of VAT. Now, HMRC do say that once the VAT group has been approved, these will all be automatically cancelled. But what they don't say is that actually what happens if they refuse the VAT group application for basic reasons of protection of the revenue. That's a separate story. But the issue we found with this is that actually we've had a number of companies where they're trying to form a VAT group have actually submitted their VAT returns for the single entities. And what HMRC then do is actually move the effective date of registration for the VAT group forwards. Now, this could be an issue if you're trying to claim pre-registration input tax. Say if you're forming a VAT group of a big co, so you just of an acquisition, and the trading sub's already VAT registered, but the big co isn't, and you're looking to recover the input tax on legal and professional fees connected with that deal. It means that something could be timed out, because if it's say moved 6 months forwards, you lose 6 months of input tax recovery. So the key message really on this is if you're making that forming a VAT group with a already VAT registered entity, is don't submit the VAT returns, which seems a really odd thing to say coming from a VAT specialist, but don't submit the VAT returns as it will affect the effective date of registration for the VAT group. The other one is just a target group case. A target group, we're providing loan administration services to a number of banks. And the key factor in this case is that these services started after the loan was agreed with the customer. Obviously, various things can be exempt, including transactions, including negotiation for deposit and current accounts, for transfers, for arranging debts, for arranging loans, but it excludes debt collection. Now, Target Group had not provided any loan or origination services to the bank, so all the way through the courts, first tier tribunal, upper tier tribunal, Court of Appeal, all refused the appeal, and now the Supreme Court has done the same. And they said that basically to be VAT exempt, the service has to have the effect of transferring funds between the bank and the customer and changing the legal and financial situation for both. It's not enough just to give instructions and to provide the administration services. Now, the reason why this is an important case is because it's actually overruled a number of Court of Appeal cases where basically the Court of Appeal has said that the VAT exemption for loan administration service can actually apply even just for making entries into the loan account. So what we're expecting is that this is going to have wider effect. I'm expecting HMRC to review all services to do with the cycle of a loan, basically, and whether or not actually some of these should actually fall within the VAT exemption or not. And really the key reminder is that VAT exemption should always be interpreted narrowly. So if you're trying to squeeze something into a VAT exemption that shouldn't be there, don't bother. Okay, Malcolm, back to you.
Thanks very much, Rob, and thank you very much, Nigel. We don't have any questions in the Q&A, so if you do think of some, do pop them in the Q&A. We'll pick them up at the end. But at this point, let's hand over to Helen Berry, please. Thanks, Helen.
Thanks, Malcolm. Good morning, everyone. Just thought it'd be worth highlighting a recent consultation that HMRC have undertaken in relation to charities tax compliance. Next slide, please. So the consultation was launched by HMRC in late April 23. Obviously, BDO were one of the many parties to provide a response to this. So I thought I'd go through some of the relevant points because I'm pretty sure that changes are afoot with regards to charities tax compliance. So it's a case of watching this space. So what HMRC said they wanted to do, they wanted to explore reasonable and proportionate changes on how to reform some of the tax reliefs that don't currently work, in their opinion, as intended, in the hope that such amendments would tackle any non-compliance and protect the integrity of the sector. Next slide, please, Jordan. So HMRC have been looking at 4 areas in particular in this regard. The first being a piece of supplementary anti-avoidance legislation known as the Tainted Charitable Donations Relief. For those that don't know, this replaced the previously known substantial donations legislation back in 2013 that they didn't think worked as intended either. Another area of focus is the approved charitable investment rules, next the non-charitable expenditure rules, and finally non-compliance of filing obligations. So we're just going to look at those areas in a little bit more detail in terms of the changes. Next slide, please. The tainted donations rules, as I said, they replaced what was the substantial donations rules, which HMRC thought were too broadly set, basically. So they looked to change those and introduced in 2013 the tainted charitable donations rules. Now, this is a purpose test, which considers both the effect of and circumstances in which the donor or someone connected with the donor has entered into arrangements to make the donation, and whether the main purpose of that donation was to obtain a financial advantage. The last of the conditions in this regard is only applicable to wholly owned subsidiaries. So in the vast majority of cases, in terms of donations, isn't applicable, but it's an exemption for where you do have corporate entities that are making charitable donations up to their parent. Now, to fall within the tainted donation rules, all 3 conditions have to be met, and if they are, the donation is considered tainted. So what does that mean? Well, the donor would lose tax relief, and there's a potential additional charge where their donation would have been eligible for the gift aid scheme as well. Next slide, please. So what were they looking to do, or what were they consulting on? Well, HMRC's consultation sought views on 3 possible options in relation to the tainted donation rules. The first one being to replace the existing rules with a new rule that, in their words, would be fit for purpose. The second would be to remove condition B, and the third would be to amend condition B. In terms of our response in this regard, it appears that HMRC are now trying to find a middle ground in terms of this anti-avoidance legislation. So as I previously said, the substantial donations rules were, in HMR's view, and probably our view, too widely set and captured a lot of things that were not intended to be caught. So they introduced the tainted donation rules, which in HMRC's view are now too narrowly set. So it appears that they're now trying to find this new middle ground. Our suggestion in this regard would be to not find this middle ground, but to use other areas of primary legislation which are more than adequate to capture unintentional circumstances, and we'll cover some of them in a moment because there are other areas that HMRC are actually consulting on to change. In terms of the removal of condition B, the purpose test, we believe that this would adversely impact the level of legitimate donations people would make, and obviously detrimentally impact the sector as a whole. And like I said before, there are much simpler and potentially more effective ways to counter this perceived issue of illegitimate donations. Next slide, please. Okay, moving on to the approved charitable investment rules. These enable charities to invest excess funds, allowing them to advance their charitable aims without treating them as non-charitable expenditure, which can, in the majority of circumstances, restrict a charity's tax exemptions. For those people that aren't aware, there are 12 types of approved charitable investments, but currently only type 12, the other category, includes a for the benefit of the charity test. Now, HMRC have sought views on extending this benefits test to the other types, for which we don't see there being any issue in the main with. I mean, these are very effective rules and work very well when policed as intended. So in addition to this benefits test, they are also looking to introduce stipulations around HMRC being able to request documentation and evidence to support the reasons behind the investment, to be able, in terms of justifying their investment decision-making process and being able to demonstrate how those investments do benefit the charities. Whilst we don't see any detrimental effect in this, because charities should already be carefully considering and documenting their investment decisions, we do request that HMRC issue clear guidance on what records and documentation would be acceptable as evidence in this regard. Next slide, please, Jordan. Okay, so non-charitable expenditure rules. Charity, as you may or may not be aware, charities receive tax relief on most types of income and gains, provided they are used for charitable purposes. However, if a charity incurs non-charitable expenditure, they lose the tax exemption on an equivalent amount of their income or gains, and a tax charge may arise. Now, the rules in this area are complex, And whilst we don't object to a review of the definition of what is attributable income and gains, HMRC did not provide any further details as to what those changes or amendments would look like, and as such we were unable to comment further. Another area they have raised is the possibility of extending the current 6-year look-back period or clawback period. Now, we have stated that we do not recommend this. The 6-year, it's widely accepted that records are retained for 6 years and in some cases more. And we see that any extension of this 6-year look-back period would cause significant additional administrative and unnecessary costs to the sector. Okay, next slide, please. So the final area that they have been seeking opinions on is in relation to sanctions for non-filing of tax returns. So HMRC in this regard have sought opinion on withholding of gift aid payments or disapplying other tax reliefs that are available to charities. I think it's fair to say that there's a general lack of understanding within the charity sector regarding their tax filing obligations, and our experience suggests that many, mainly the smaller charities, incorrectly assume that they are fully exempt from tax. This isn't helped by the fact that there are mixed messages within the sector in terms of filing obligations, in that some charities may never receive a request to file a return. Others are on what's called a periodic review, where they file a return every 3 or 5 years, depending on their activities. Obviously, there is still a self-assessment requirement there. And other charities, both large and small, still have an annual filing requirement in many situations. So we request that HMRC applies a more consistent approach on this. We also think that it's extremely important that HMRC engage with the sector to educate them better in this regard. We do not think unnecessarily penalising them by withholding what is a very precious funding for them in terms of the gift aid scheme or disapplying reliefs is the appropriate way to go. As you know, they already have statutory filing penalties that they can apply, and in our experience they are significant enough or not unsurmountable to ensure that charities do, where requested, file their corporation tax returns. And obviously those that persistently fail, we would encourage HMRC to have an open dialogue with them to understand what is causing the failings. As often, as many of you will be aware, smaller charities and the lack of funding within the sector mean that often staff turnover is an issue, as well as the lack of access or available funds to pay for professional advisors in this regard. Thank you. And finally, just on the last slide, so our conclusions for this, we believe that it's preferable to overcome abusive behaviour by reference to core existing primary charity tax legislation wherever possible, with perhaps some minor tweaks, amendments being made without a full-blown replacement of some supplementary anti-avoidance legislation that they have previously done unsuccessfully as well. A core principle approach to the tax legislation is that it should be made as simple and as clear as possible, as I'm sure you're all aware. And advisors with charity clients will need to monitor this very carefully, as undoubtedly there will be changes afoot in this regard. Thank you very much.
Many thanks. Many thanks, Helen. That's very good. Thank you. A couple of questions for you, if I may.
Okay.
We've got the autumn statement up and coming very shortly. Any thoughts about whether there's likely to be anything in the autumn statement that might impact charities and not-for-profit?
We haven't heard any specific noises in this regard. In terms of charities directly, there has been some more proposals that would affect other organisations as well as charities. So I deal with a number of charities in the creative industry sector as well. So there's already talks around proposed changes in relation to the creative industry tax reliefs, and I suspect that those changes may go ahead following the autumn statement, but as yet I'm not aware of anything in particular.
Okay. And that consultative document, presumably the period for making representations is now closed?
Yes, it closed at the end of July.
End of July. So do we think there might be anything in the budget coming out of that? Is it likely to be too early yet?
I think it'll be too early because, as I said, I mean, the consultation was very vague around what suggestions they were putting towards them. So a lot of our responses were, you need to provide us more details to enable us to comment further. So I don't know if more will come from that before they make any substantial changes.
I suspect the Chancellor might have other things to concern himself with, aside from charities and not-for-profit. So. But watch this space. I've been surprised in the past. That's lovely. Thank you very much, Helen.
Thank you.
Next slide, please. And we're over to Chris. Chris, it's all yours.
Thank you very much. Thank you very much. Right. Right. Yeah, I'm here to talk to everyone about tax treaties, how to interpret them. Is probably a large part of my work over the last 33 years has been looking at treaties. So I thought I'd give a quick overview. So next slide, please. Right, I think everyone understands that treaties are there to try and seek to prevent double taxation from two jurisdictions. I mean, the way they determine is what most people appreciate is that there is an OECD model article, which is always the starting position when two countries are trying to negotiate, and then they negotiate their own terms as they then tag onto these. The UK itself. When we're interpreting, the key thing to remember when we're interpreting treaties is we actually rely heavily on the OECD guidance. If something is in the OECD guidance, HMRC will accept that interpretation when we interpret it from a UK position. However, not all jurisdictions do that, so there can be mismatches between interpretations by the UK authorities and foreign authorities. And when that happens, that's when we can end up with quite difficult tax duplications. So the primary places where you need to look is there's some definitions in the article in the articles of the tax treaties which may have limited help. The OECD guidance is always a go-to place when you're trying to interpret it, and I'll be demonstrating that as a couple of points in the presentation. I'll be looking at that. And the revenue manuals, both the double tax relief manual and the international manual, do talk a lot about treaties and such like, and the double tax relief manual in particular goes through country by country, bringing out key points and highlighting them. But yeah, again, this last point is quite critical. We've got it, and it's something which I find myself explaining to people a lot, and that is that the treaty only applies for gains and incomes and individuals between the place that they're resident and income and gains from another jurisdiction. Yeah, if they got income and gains in a third jurisdiction, it's not covered by that treaty. So, for example, if we have a dual resident, and the treaty determines them to be treaty tied in one particular country, that's fine when we're looking at income and gains from those two respective countries. But if there's income and gains from a third jurisdiction, as far as as far as the UK and the other countries concerned, they're both resident there, so they're going to both seek to equally tax that income from the third jurisdiction. So we do always have to be careful when we're talking about people, particularly when people are treaty tied, or maybe if they're if they're living in another jurisdiction or they're citizens in another jurisdiction which tax on a worldwide basis like the US. We always have to be careful of third country income and gains and making sure we pick them up correctly. Right, first slide, please. Or next slide, please. Right. Most of my slides here are just going to be excerpts from the treaties. I'm just going to talk through them so to show how they. Residence tiebreaker, which I've already mentioned. I think most people should be familiar with how you treaty tie individuals. It's probably the bit of the area that most people. It's probably one of the reasons that most people look at treaties, or it's one of the bits they look at most. And it's just how you determine if somebody is dual resident. For the purpose of the treaty, do we treat them as resident in one jurisdiction or the other? Now, for individuals, it's a fairly simple test, as you can see there on the left-hand side. Although you've got to go down the list of tests. Most treaties have a very similar test along these lines. This Belgian one here is pretty typical. There might be slightly different orderings and such like, but it's primarily like that. So you just go down the list and determine. However, when it comes to non-individuals, for companies, for example, it can be much more complex, and this is quite important because you may be aware that at the start of CTA 9, there's all the definitions it covers the scope of corporation tax, and it basically says that if you are incorporated in the UK, you are subject to corporation tax wherever you're a resident. So it's difficult to export a country to another jurisdiction and this to escape a UK company to another jurisdiction to escape UK corporation tax. There is one exception to that, and that is where it's where under a treaty that company is considered to be resident in a different jurisdiction. Now the problem with that is that different treaties have different interpretations or have different tests. So you can't simply say it's always going to be just by exporting a company to another country is going to be non-resident from UK purposes. If they go to a country like Denmark with a treaty that talks about effective management, and you take the company over there and the management go with them, then you should be able to argue that it's treaty tied to Denmark, and therefore it's outside the scope of UK corporation tax. But countries like Japan, with treaties like we have with Japan, where it's on a mutual agreement, you cannot make that determination without going through the process of seeking mutual agreement between the jurisdictions, and that can be a very long and lengthy process and expensive. So it's not one that most people would want to do, and there's no guarantees either. There is a halfway house. There is a couple of Canada, for example, has one where it is on mutual agreement, but it says it's on mutual agreement, but the states will make the decision based on effective management. And I am conscious. I've recently been involved with a company from Canada, which is relocated to the UK, and that particular one, they are making an application to the Canadian authorities under the treaty for them to agree that effective management has switched to the UK, and I believe it's about a 6-month process. Once you can find out the right person to speak to in the Canadian authorities. So it is a lengthy process, but it's much quicker than it would be if for one with not that extra bit in the treaty. Next slide, please. Right, business profits here. Right, business profits. There's a couple of things to say here. I'm going to talk about what the definition of an enterprise is in a moment on the next slides. So I'm going to part of that for the moment. I want to highlight the language here, taxable only. I'm going to bring that on. The important thing about when it says taxable only, when the Latin language is used, then I mean it's purely for some reason this is something people do get confused with, but it says taxable only. That tells us the position for both jurisdictions. It says it will be taxed in one state and it cannot be taxed in the other. Yeah, bear that in mind. I'm going to mention that again in the next thing. But most treaties talk about, basically most treaties will give sole taxing rights to the country where the enterprise is resident, unless there is a permanent establishment in the other jurisdiction, in which case it gives them the other jurisdiction permission to tax the profits of that permanent establishment. Now, all the other 2 to 5 here, they're all about how you calculate the profits and such like. But effectively, it's it's the country of residence unless there's a PE in the other jurisdiction. That's the rule. And then under most domestic rules, they give a credit for taxes if there is anything paid for a permanent establishment elsewhere. Right. Next slide, please. All right, what is an enterprise? This was an interesting case. This came up recently with we had a bit of a discussion with our German colleagues a few weeks ago on this very point. We had a UK resident partner of a German partnership which was carrying out a trade in Germany, and there was all this question mark. Well, what is the enterprise? The partnership, if under normal common law English, we'd say that the LLP was the enterprise, and it was resident in Germany, and it was carrying on a trade in Germany, and therefore we couldn't see it falling, within the terms. It meant that as far as the enterprise. But then we had a UK resident partner who from using common law, they were not an enterprise. And therefore it was hard to work out whether they were taxable or not. Did they fall within the business profit article or not? And in the end, we went through a lot of the interpretations. I say the German treaty had something around about enterprise being being a business, carrying on a business activity, something like that, vague like that. We ended up looking at the OECD guidance at the end, and it very much here, it does talk about the enterprise applies to the carrying on of a business. Activities of an independent character must be considered to constitute an enterprise. So we concluded that because the individual is deemed in the UK is deemed to be carrying on the trade of the partnership, they are actually an enterprise for the purpose of interpreting the treaty. And when we stood back and looked at it, actually that made sense, because it was the other way round. We wouldn't want the revenue wouldn't want to be denied being able to tax non-residents of UK partnerships. So we felt that the HMRC should accept that as being the correct interpretation. So and certainly that's the position we've fell to at the end. So is so the enterprise is anybody carrying on a business, whether that's a sole trader, a partner in a partnership, or a corporate. Next slide, please. Right, dividends. Let's move on to dividends first. I'm gonna go back to this where I'm saying maybe taxed here. This is where the confusion. This is the use of the language. I mentioned before how taxed only in looks at sort of sets out the tax for both. The bit that seems to be confusing when it says the contractor state may be the income may be taxed in one state or the other. It's simply permitting one country to do it. It doesn't give any ruling about what applies in the second jurisdiction, and often the article in the treaty doesn't say what happens in the other thing, so we just assume normal rules will apply. But too many times, I come across people who interpret may be taxed as being solely taxed, and so it's very careful to appreciate how the English. I'm not sure whether it's a translation thing, because I've often these come from people from overseas, but it's just that you've got to make sure we use the right language. So with dividends, as I say, normally this is a fairly typical treaty with the Czech Republic. Dividends may be taxed in the state where the individual is resident, so it gives permission to the country of residence of the individual, of the recipient. However, most treaties for dividends give some taxing rights to the country in which the company is resident that is paying the dividend. although it often will be capped at an amount. Most European countries, it's between 15 or 10. It's either 15% or 10%, and a lot of jurisdictions are 15%. So it gives permission. Now, you will be aware that if you have a UK resident who is receiving dividends from, in this case, Czech Republic, if they are subject to withholding tax or tax over there at a rate of more than 15%, the revenue will cap the foreign tax credit that they will allow to just the 15% treaty rate. Because as far as they're concerned, they shouldn't. Why should they give up more than that when the treaty says that the other jurisdictions shouldn't be charging you more tax? So you have to go back to the other jurisdiction and request any refund of tax that they've charged of greater than 15%. So that's it. This section 4 down here. This is another bit that this is very similar to the German treaty as well. We had another issue with the Germans about the holding. Where they had this German partnership also had shares in a big in a substantial holding in a big German company, which paid very, very substantial dividends, and they were arguing that basically because the dividends were held by a partnership which was in Germany, had a PE in Germany, then it must fall within paragraph 4 and therefore be taxed under the business profits articles, and basically being solely taxed in the UK. Sorry, in Germany. Basically saying the UK wouldn't have any tax. But we were looking at saying, but that's not true. It says that the holding, the treaty says the holding must be effectively connected with that permanent establishment. And this is something we're going to look at on the next slide in a bit more detail. So next slide, please. Right, what is effectively connected? Now, HSC manual says along the lines, is that the first section there? It's more than just the holding of shares. Yeah, it's okay if we're reinvesting profits of the branch, but if we're simply receiving money from the head office and investing it in that PE, then it's not effectively connected to the trade of the PE. And then there's a lot more in here in the OECD guidance that all sort of reiterates the fact that it needs to be more than just the ownership of shares. It needs to be linked to the business of the PE. And in the end, we concluded that in our case that because the shares actually existed before the trade, that it couldn't be effectively connected and such like. Or we actually. And our problem here was that we were being told that the German authorities wouldn't take that approach. So our concern here is that the German authorities would say it's effectively connected, seek to tax it at the full dividend rates. The HMRC wouldn't accept it and would restrict the tax relief in the UK to 15%. So we think this is maybe one of those cases where there could be a interpretation difference that could lead to additional taxes. So we're exploring that at the moment with this particular client. Next slide, please. Interest. Now, interest is there's a couple of things here. Interest is one where actually most treaties seem to be along the lines of Spain, where they simply say it's only taxable in the jurisdiction of residence. They don't notice, but some treaties like Kenya do have a similar clause to the dividends where they give the source country a right to tax something, in this case 15%. So you need to check the treaties on interest. I think in most cases you will see that they are taxable only in the country of residence and not in the country of source, but sometimes they don't. And again, you'll see this paragraph 5 here, this effectively connected rule. This was actually in both the Spanish treaty and the Kenyan treaty. This is also quite often there in the interest article. It's the same effectively connected that we just talked about from the dividend side. Next slide, please. Capital gains. Now, Canada's one of the more interesting ones, but let me work through for the last point. But let me work through the other points first. Most treaties will go through a list of items where they want to make a determination one way or the other of how it's going to be taxed. Immovable property or real estate is one of the main ones where they basically normally just give permission for the other state to tax it. So where the property is situated, that can often give them the right. We also have this move property in business. Again, this is another one that came up in Germany. It was a similar point around whether or not shares could be held, shares forming part of the business property of the permanent establishment. It's a similar concept we talked about to dividends. It's different wording. And again, we had a discussion with Germany around whether the shares held by the partnership were forming part of the business property of the PE. It wasn't used in the trade, so we would argue it probably wouldn't. But what this effectively does, you may be aware, those people who have been in the profession for longer, that before non-resident CGT existed for UK land and such like, which was started in 2013. There's always been a single point of where non-residents can be subject to capital gains tax, and that was where on assets used in a trade carried out in the UK. That's a very long-standing bit of legislation. This basically preserves that right through the treaty. So a lot of countries do that. So if you're carrying on a trade in the UK or in another jurisdiction through a PE there, then you can still be subject to capital gains on those particular assets. So that's everything. So then what happens? So they normally have these lists. There's actually there's about 5 different items. I've cut most of them out. And then you would normally get is one clause that says anything that we've not mentioned in the articles above, only the country of residence can tax it. So there's normally that catch-all phrase is somewhere. The main thing to look at is when you're looking at capital gains is, do we fall into one of those categories? Some have more. I think the German one only had 2 categories or 3 or 4 categories above it. So they all have a different number of categories where they've identified it. But there's always going to be that clause. The Canadian treaty, the reason I picked this one out is it's got this extra clause in. This is sort of one of those funny clauses that you sometimes find in articles. Now, this is particular Canada. Canada has a exit charge on residents when they break residence. So their assets are all subject to a capital gains tax charge, a market value, at market value on their exit. So they've included this clause in there, which basically says, to the extent that we've already taxed this, we've levied an exit charge, the UK will actually will give them a basic cost uplift and will only tax the gain that accrues after they move to the UK or after they've left Canada. So this is very specific to Canada to counteract their very specific exit rules. Australia has a similar one, and Australia has a similar clause, and it also has an additional clause about deferral, because in Canada it's possible, in Australia it's possible to defer the payment of that exit charge tax. So there's also an extra clause in the treaty that deals with that deferral mechanism as well. Right, next slide, please. Employment. Okay, this will be fairly quick. Most jurisdictions will only allow the country where you're resident and carrying out the duty, to tax the employment income. However, fairly standard is this approach whereby if someone is in the other jurisdiction for basically 6 months, 183 days, it does there are circumstances where the country where the person is carrying out those duties can be taxed. Now they all have similar tests. There's normally 3 tests. The 183 test can vary slightly. This one talks about, the Australian one here talks about in any 12-month period. So you have to look at on a rolling 12 months, do they exceed 183 days? There are 1 or 2 there are a few treaties that look at it on a fiscal year basis or on a calendar year basis. So you look at a fixed period, but most do look at this rolling 12-month period. So you just got to be careful of the exact wording there. the remuneration is paid on behalf. Yeah. So there's the next ones. It's all about, these are conditions, is who's paying the remuneration. If they're paid from the jurisdiction where they're carrying out the duties, and it tends to be taxable there. There's also the third one. This is not deductible and determined. That is often replaced by the US treaty has talked about is not borne by a entity in the other jurisdiction, and that's a much a tougher test to pass, because, for example, if it's a UK company, an employee of a UK company, and they are seconding someone over to their US parent, even though all the costs are being borne by the UK company, because that's owned by the US company, that's seen to ultimately bearing the cost through its reduced dividends, its reduced profits and available to it through dividend. So that would fail that particular test under US treaty. So we've got to be very careful when we're looking at this on the relationships between who you're doing the work for and who is actually paying the fees. Right, next slide, please. All right. Important to know, in most treaties, directors are not covered by the employment tax rules. Yeah, Australia, which was on the previous slide, is the exception. You would have noticed point 4 there says directors are covered by this article. Yeah, most treaties have say something else. Now, Brazil is quite a typical treaty that it simply says, you know, if you're on the board, if you're receiving fees for being on the board of a company in the other state, then they can tax it. So it gives them permission. It gives the country in which the company is resident to actually tax that state, even if you're not resident. Tax that director's fees, even if you're not. Yeah. Next slide, please. Pensions. As you may know, Sadiq and I are BDO's pensions tax advisory team. So we look at pensions and treaties about pensions all the time. Now, this is probably the bit where this pensions articles are the most varied of any topic. Yeah. The pensions articles themselves are fairly good for, you know, a standard pensions, but when it comes to, you've also got to look at where's the government pensions, civil service pensions, that could be under a different the government article. It could be under other, or it could be under this. State pensions are the same. It could be that there could be only, so it can be hard to find what you need. You basically look everywhere. The other thing to remember on terminology, this particular German article talks about pensions and other similar remuneration. That phrase is important. Other similar remuneration means that it includes lump sums. If it doesn't use the phrase other similar remuneration, it does not cover lump sums. That means there's actually a lot of treaties out there that don't cover lump sums. So we need to, how do they come? Do we need to rely on the other income clause and things like that? So, as you'll see, this is a fairly German treaty is actually one of the odd ones, because of the Article 3. Para 1 is a very standard. It shall be taxed only in the state of residence. Basically, that's the case for most treaties and pensions. There are some exceptions. The German one is that has this odd clause in there, which did trip me up the very first time I saw it, and that is along the lines of, if that applies, but if you had a treaty, if you have a pension which accrued over a period of more than 15 years in the other state, actually the other state has the right to tax it. So if, for example, you have a UK resident, a German living in the UK who had a pension, who was receiving a pension which he'd accrued from, let's say, 20 years of employment in Germany, German has the taxing rights over that and not the UK. So this is another case where you have to be so careful reading the treaties. As I say, I was tripped up from that when I first came across it many years ago. Luckily, the German advisor picked up on it, so I was okay. Also, as I've put an example from the US here, some treaties do have a very specific power covering lump sum payments, as does the US, where the US basically says the lump sum is only taxed in the country of source. And that sort of helps preserve. The reason for that is it helps preserve some of the exceptions, some of the exemptions that might be, the 25% lump sum in the UK, or the US have a few exemptions as well. So it helps preserve that. There are some clauses that also, there are some provisions that also have a clause in there that says to the extent there's an exemption for the pension, it has to be honoured in the other country. So some do get around it that way. So yeah, that's pensions. Next slide, please. Conscious we're at the hour, so this is my last slide. Couple of sundry articles you need to be articles you need to care of. The non-discrimination article will normally talk about personal allowances. Pretty much all treaties say this treaty doesn't entitle you to a personal allowance. Just because you're a resident in one country doesn't mean you're necessarily entitled to personal allowance. That's what Para 5 is saying there. However, this paragraph that talks about, there's normally a paragraph, or there's often a paragraph that talks about non-discrimination itself. This one talks about nationals of a contracting state shall not be subject to catch on what we taxed any differently. But that actually, if you're a national of the USA, the UK must give you a personal allowance, regardless of where you're resident. So it doesn't, you don't even have to be, this is the record. If it doesn't matter if you're US, the UK, or somewhere else in the world, if you're a national of the US under this treaty, you are required to give a personal allowance. Now, that's something that's the source of that. I'll be honest, most people, I think, when they're looking at do we get a personal allowance, there's certain bits in the revenue manuals or in the revenue guidance which lists it, but this is where those lists are derived. It's looking specifically at this case. Right, the very last point, I believe, is this remittance point. Many clauses, many treaties around, especially Europe, will include this sort of clause which catches those non-doms, the UK resident non-doms. It basically says that regardless what this treaty says, who gives taxing rights, if you are only taxed in the UK on the remittance basis, then we're only going to give you treaty relief to the extent you remit those monies to the UK. So you always, if you have got a non-dom who's thinking about not remitting is going to rely on the treaty and is not going to be remitting all of the monies, you very carefully need to look at this treaty, see if this clause is in that treaty. Next slide, I think, is the Q&As.
Thanks, Chris. Do you want to stay on video for a sec?
Sure.
I have time for one question for you. This is a UK holding company with a non-UK sub. The question is dividends coming up from the UK sub, obviously not taxable in the UK, but the treaty states it may be taxed in the state where the subsidiary is resident. So let's assume that the subsidiary deducts tax on its dividend it pays. Can the UK claim credit for that tax?
Yes. This is similar to if it was an individual. Yeah, if there is, I think US is a typical. US withholds 30% on most dividends. You can. The first thing to say is the starting position is to make sure that the tax that's being withheld or deducted in the other jurisdiction is the correct amount under the treaty. In the US, that would normally be 15%. And once they do that, then the UK should give a credit. Although actually saying that, it's not the dividend itself is not taxable in the UK. Actually talking about it, the answer is no in this situation, because the dividend itself is not taxable. The way the UK works, the way the UK tax works is you're only entitled to a foreign tax credit against taxes that you incur on that particular source of income. So if you're receiving a dividend which is exempt under UK tax and there has been a foreign tax credit thereon, you're not paying the tax. You can't reduce a nil tax bill, a tax rate. So in effect, you will not get credit. So there needs to be a UK tax arising on that income to be taxed. So the answer is, so I take back my initial thing. The answer is no. You simply have to bear that cost, which is why minimizing that cost and being careful and being aware of foreign tax credits and how it's being charged is quite hard. But if it's been, say, withholding on trade income, which I know US also do, then obviously you get a credit against your trade income in due course. So
thanks, Chris. Can we have the next slide, please? So just a reminder before we all depart. Next update is the final one for 2023. It's an afternoon webinar on the 13th of December 2023. We look forward to seeing you then. Invitations should go out in the next week or 10 days. Do please sign up for the event. I'm assuming the recording for this one was recorded accurately. We'll send out a recording today to you as well. So we look forward to seeing you on 13th of December. Have a fantastic remainder of the day. Thank you all very much for attending.